Hello and welcome to this Thursday market update. Although I am recording Wednesday evening, I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. It's a pleasure to be with you all at Stockcharts and YouTube again this evening. Let's go ahead and take a look at the action that we saw on Wednesday to close out just before the holiday on Thursday. The S&P 500 did finish up for the second straight day, closing at record all-time highs. Back above 5,500 these past 2 days, today closing at 55.3702. Again, that is a record. We have not seen any closes prior to the last 2 days above 5,500. So that's good news on the S&P 500. Looking at the Nasdaq 100, the NDX, same thing. 2 consecutive closes at all-time highs, in this case, over the 20,000 level. So the Nasdaq 100 up 174 points on Wednesday. That is almost 0.9%. Another very, very strong day on Wall Street. I want to spend a little bit of time today talking about transports. The transports, as you can see, have broken back out above both their 20-day and 50-day moving average. We've been trying to get through this 15,500 level. Haven't been able to do it so far. But at the bottom of this chart, I want to really focus in on the correlation between transports and the S&P 500. Now, I know when, transports, we've had a really difficult time in 2024. A lot of technicians pointing out that according to the Dow theory, the fact that transports are not confirming the move that we saw recently on the Dow Jones above 40,000, setting a new all-time high, that this is reason for concern. I would say it's something to watch. I'm not concerned about it at this point. But I just want to point out how the transportation stocks work relative to the S&P 500. So down here at the bottom of the chart, I have correlation. This is a really cool indicator over at Stockcharts. I do a lot of my research using correlation. You can take a look at any 2 stocks, industry groups, sectors, major indexes, asset classes, whatever you want to do. You can compare them and look to see if they are positively or negatively or inversely correlated. And in this case, the long term, the S&P 500 and the transports are very, very positively correlated. But on the chart, you can see that about a month ago, we went down and we had a pretty rough period. We lost that positive correlation, and that was because the S&P 500 was moving up and transports have been moving down. Now, you can see that for the most part, over the last year, we have seen correlation remain up near or at that +1 level, meaning that these two tend to go hand in hand with one another. So this is more of an exception, what we're looking at right now, rather than a rule. And I want to stretch this out and go back a long period of time. This is going back for the last decade. And I just want you to see how tightly correlated, positively correlated, that transports and the S&P 500 typically are. This latest push into inverse or negative territory was probably one of maybe, I don't know, a dozen times over the last 10 years where we've seen inverse correlation, where we've seen the two actually not working in the same direction. So I think this is going to end in one of 2 ways. And we're already starting to see this movement back in correlation back into positive territory. And it's because the transports are going up along with the S&P 500. So they're starting to move together at this point. If this continues, I would fully expect that we're going to see the transports breaking out because I do think the S&P 500 has more room to run here to the upside. I don't like trying to call tops when we're at all-time highs unless I have a lot of warning signs, and I don't have all those warning signs right now. So I believe the S&P 500 goes up, and right now transport's starting to move back into that hand-in-hand kind of a relationship with the S&P 500. So watch first on the transports to see if we can get through 15.5. But then ultimately, we want to take out these highs from the middle part of 2023 and then again earlier in 2024. And the first area might be around the 16.2 level. And then we'll probably be looking more like 16.750. So we've got a few different levels that we need to clear. But the first one that I would be paying attention to is this 15.5 level. Can we get it close up and above that? If we do, I think transports are well on their way to moving up and testing some of these other overhead resistance levels. So watch that. Now, another thing I wanted to talk about with transports is their seasonality. So I've gone back 20 years, and you can see that the fourth quarter tends to be stronger in terms of the percentage of Octobers and the percentage of Novembers where the transports rise. You can see really starts to move up. Even December is strong in terms of the number of Decembers that transports go up over the last 2 decades, although their average return is a little bit lower and actually a little bit negative. But if you drag this 20-year slider back, and by the way, when it's at 20 years, we're looking at 2005 to 2024. So one thing I did is I slid this back over to where it was 1990 to 2004. So this is 15 years here. Look at the fourth quarter in those 15 years. So we're seeing this fourth quarter strength in transports, not just for the last 20 years, but we go back to 15 years before these 20 years, and it shows us the fourth quarter is a time that we need to really pay attention to the transports because they tend to move up. The August-September period tends to be the weakest. July tends to be okay. I actually did calculations to combine the 15 years from 1990 to 2004 with the 20 years from 2005 to 2024. And I want to just share a couple of these numbers with you. So if I break down the performance by quarter, this is what the transports average gaining or losing by quarter over the last 35 years. So it's the last 20 plus these 15 I'm showing you on the screen. First quarter, we tend to go up 3.8%. Second quarter, 1.6%. Third quarter, minus 2%. That's the quarter we're just starting right now. And then in the fourth quarter, we gained 7.2%. So clearly, if we just take the fourth quarter and the first quarter, we come up with 11% average return on the transportation group during those 6 months, going back the last 35 years. The middle two quarters, quarters 2 and 3, basically net out to zero, slightly negative. So that 6-month period from the beginning of October through March, and then we could even throw in April. April's pretty strong. That is when we historically, seasonally see strength in the transports. So while we're seeing a little bit of strength now in July, which does line up historically, keep in mind that August and September are weaker. We might have some great opportunities on transports here over the next few months. So just wanted to point that out. Let's keep moving. Let's talk about the S&P 500 and my sustainability ratios. So one of the things that I like to do to try to determine whether or not I think the S&P 500, if the advance is sustainable, is I like to look at certain ratios. So here on the top panel, you can see the S&P 500 rising. The next one is the accumulation distribution line, which is moving straight up, setting new highs as well. I think that's a sign of accumulation as opposed to distribution. Sometimes if the market's going up and we see the AD line going down, it just doesn't exactly give me a lot of confidence that move to the upside is sustainable. But that's just one indicator, the AD line. Another thing I like to follow is, do market participants have an appetite for risk? And there you can look at the QQQ relative to the S&P 500, and that tells you, yes, we're moving up to a new high. The Nasdaq, which is much more aggressive, much more volatile than the S&P 500, tends to be riskier. It's actually outperforming the S&P 500 right now, setting new highs, which is a good thing. If we scroll down, the XLY versus the XLP. This is consumer discretionary versus consumer staples. When the stock market goes up, we tend to see the XLY outperforming the XLP. That had been a problem throughout 2024, but you can see here since the beginning of June, we're actually making a really nice move to the upside with the XLY outperforming. Look at large cap growth versus large cap value. That's the next panel here. I mean, the last 2 or 3 months, growth is absolutely killing value. And if you know anything about history, you know that the 4 best months of growth stocks versus value in terms of performance comes in May, June, July, and August. Those 4 months, all of the outperformance of large cap stocks or large cap growth versus large cap value, all of its outperformance over the last 2 decades has come during the 4 months, May through August. It's one of the reasons why I don't go along with the go away in May theory, because if you go away in May, you're going to lose the 4 best months of the year in terms of performance of growth stocks. So keep that in mind. But right now, growth is outperforming. This is what we want to see, because we've got more aggressive stocks outperforming the more defensive stocks. Finally, one ratio that had been falling throughout 2024, most of 2024, were the transports versus utilities. And if you think about this one makes good common sense. When the economy is strengthening, S&P 500 profits are going up, more goods are being delivered, transportation stocks tend to do well. When we have an economy that is struggling, a lot of times we're going to bolster, we'll try to bolster the economy by cutting interest rates. That's normally what we want to do. And when you do that, it makes utility yields for those income investors, utilities yields look much more attractive. So we start to see utilities do better on a relative basis and transports do worse on a relative basis. So anytime I see this ratio going down, one of the things I think of is our economy and what kind of a maybe bearish signal this is sending about our economy. Now here in June, we've seen this ratio start to pick back up, which is a good thing. I want to see it continue. But I think that this 2024 relative performance of utilities versus transports is sending a message to the Fed that our economy is not quite as strong as the Fed might think. And if they leave rates up too long, we could see the economy start to teeter. So I like the fact that we're starting to move back up here, but this is one I'm going to want to keep an eye on to make sure that the market is believing that we're going to get rate cuts. And I think the fact that June, we started to see transports go up, I think that's a sign that the market is anticipating that the Fed will cut. I don't think they're going to cut at the July meeting, but I do believe they're going to cut at the September meeting. And we'll just have to wait to see if I'm right on that. All right. Let's move on here and talk about the spider and the various sectors. This is going to be the next segment that I want to get into. But before I do this, I do want to just make everyone aware of our free newsletter. So we have an EB Digest newsletter. It's completely free, no credit card required. You can unsubscribe at any time. On your screen, if you simply scan the QR code, it'll take you to a landing page where you can sign up. I'm going to go over and talk about the strength that's coming in the XLY, consumer discretionary. And one of the stocks that I'm going to feature, the stock I'm going to feature on Friday morning in our EB Digest is going to be one of the consumer discretionary names. Don't think you want to miss it, because this is a stock that had been doing extremely well, has pulled back, is consolidating, and I think getting ready for another big move to the upside. So make sure you scan that code and check that out. So speaking of this RRG here, and I really love the RRG charts. I showed them last week, introduced them in the first video of these Thursday updates, and I got a lot of positive feedback. So I'm going to spend some time talking about some RRG charts here. First, the benchmark here is the S&P 500. So RRG charts, what they show is going through relative strength, going through various quadrants. So as you start to strengthen, what you will see is movement in the northeasterly direction. So you'll be going from improving into leading. And then as you consolidate, take a pause and break, you'll go down into weakening. And then leaders normally will come right back up to leading. Other stocks that might barely get into leading and come back into weakening, stocks that maybe haven't been performing as well, or in this case, sectors, a lot of times will move up, move back down, and then quickly move right back to lagging and improving, and then, just rinse and repeat. So here is this is going back 6 months. This is the daily RRG. And so what I wanted to show you is right now, as of July 3rd, and you can look right here, it's a 5-day tail on each one of these sectors. So it's just showing you where it's traveled from over the last 5 days. The longer the tail, the more powerful the move. Julius de Kempenaar, who's the founder of the RRG charts, he's on here. He talks about his RRG charts a lot. I would certainly recommend that you listen to some of Julius's presentations and videos if you are an RRG fan, because he'll go into a lot of the details. What I want to go over here is just simply watching the visual of this rotation. So if we go all the way back to the beginning of the year and we start moving forward, you're going to see, in the very beginning of the year, some of these groups not doing so well down here, but look at what's leading. Technology, communication services. When the S&P is going up and it is being led by the aggressive groups, that is very bullish and it shows us signs of sustainability. And you can see the S&P 500 continued going higher. So what we want to kind of do, and you can follow technology just by clicking on the technology down in the table below, and then scroll through this chart and just watch what technology does. Now, we struggled from March to April. We kind of stayed over on the left side of the chart, but watch once we hit a bottom. Look at the XLK accelerate. And by the way, when we were at this high back in May, as we're accelerating, you can see utilities actually down here. It was one of the biggest leaders for a while. And a lot of folks wrote into me and said, well, isn't that a bearish sign? We got a defensive group leading the market. Well, it bounced. And so it's going to show some leadership, especially on the daily RRG when we get a bounce. It won't show as much strength on a weekly RRG. But anyhow, let's go back to that technology, because since we've broken out, you can see technology, see how it went down into the weakening and then turned right back around and shot back up into leading. That's what I'm talking about. And if you notice, the XLK is the only sector on the right side of this chart. It's the only sector showing relative strength. And this is what worries a lot of folks, because it's telling us that the breadth isn't there, because we're seeing so much strength coming from one group. Well, as we continue to move on and we see technology start to move lower, mostly because semiconductors have been so weak, look at all these other groups starting to rotate. So as money is coming out of technology, now we're starting to see it evolve in other areas. And that is the consumer discretionary group, as you can see, leading the pack now in terms of momentum, improving. It's right up there with financials right here. And then energy has the most momentum of all right now. But we haven't yet moved into the right side where we show relative strength. So we're moving from left to right. We are showing relative strength, but it's at this point, what it is really it's less relative weakness. So here you've got a lot of relative weakness. Here you've got relative weakness, but it's not as bad as it was. That's different than improving your relative strength over here in the leading quadrant. That's my interpretation. So the XLY is an area of extreme interest to me right now. So I wrote an article at Stockcharts about a week ago, and I wanted to just show you a couple highlights from that real quick. If you go to the top of the article, I wrote, an old game we used to play, if you're old like me, tag you're it, where somebody would be it, and then, they're trying to find somebody else basically to pass the baton to, tag them, and now all of a sudden they're it. They've got to find somebody. The stock market works in very similar fashion to that game. And that is, once somebody else has been tagged, then that person is the one that's kind of the leader or in charge. In the stock market, we had technology leading this advance in 2024 to the upside. But now it's been starting to weaken, and we're starting to see all these other groups start to show strength in terms of sectors and industry groups. And so that's what this article was about. And by the way, if you go over to Stockcharts, if you go to articles, you can get to my article a couple of ways. It was published last weekend. So this is the chronological order of articles. Here, you can get it from the popular article, or you can just go right down to trading places and then scroll down. There it is, and you can pull it up. But while you're there, put your email address in. This is a way for Stockcharts to send you an article immediately when I publish it. So if you provide your email, there's no charge, there's no credit card, there's no marketing. Stockcharts doesn't reach out for any other reason other than to tell you that an article has been published. And this goes for every blog author at Stockcharts, not just me. So if you have a favorite author over there, make sure that you sign up with your email, hit that submit button, and then as soon as we publish, the article gets sent to your email. It's a great, great service at Stockcharts, so make sure you take advantage of that. But here, if you're looking at this chart or this article, you'll see that I like internet stocks. I like the fact that they're breaking out on a relative basis right here. We've been sideways consolidating for a few months relative to the S&P. We just made a breakout. I think internet stocks are poised to take over, to take that baton. I think within internet stocks, we could look at a stock like Google. I'm going to show you that chart was in this article as well. Also, consumer discretionary. We had a triple top on the absolute chart. And now what we're waiting for is this big breakout to break this downtrend back to the upside. And I think it's already started. So when we look at individual stocks, I mean, we've had NVIDIA, which was part of the semiconductor group, which obviously was it for a long time. But they've now passed the baton, at least for now. And so the three stocks that I wanted to look at was Google. You come down here to Amazon in a nice bullish ascending triangle that just made the breakout when I published the article. And then finally, Tesla. And if you go down here to Tesla, clearly we're in a downtrend, but I saw a lot of improving signs on Tesla. And one of the things I suggested was that if the stock, somewhere in here, I want to see gap resistance near 208 cleared, because after that, I don't see any major resistance until 265. So we saw the relative breakout when the stock was trading below 200. 208 was a big level to clear. And once we got through that, let me show you what happened. This was where we cleared 208. Last 2 days, we've gone almost all the way up to 250. So there wasn't a whole lot of resistance until all the way back to the high at the beginning, or excuse me, the end of 2023. And that seems to be where we're heading right now with Tesla. So I just wanted to point that out. That's how rotation works. All of a sudden, NVIDIA had a good day Wednesday, but that's still, almost 10% down from its recent high. And yet the Nasdaq's breaking out to all-time highs. How does that happen when you have a leader falling, 10% lower? Well, it happens because of the rotation, because of tag you're it. Now we've got Tesla leading. We've got Google that's broken out. We have Amazon that's broken out. We have a number of other areas, a lot of software stocks performing well. And so they're now picking up the baton and running with it. And that's why we continue to move higher. A lot of folks guarantee if you'd asked them, what happens if semiconductors pull back 15%? I think probably almost every one of them would say, well, we're in big trouble. And yet that's exactly what happened with semiconductors. And we barely budged to the downside. Money is rotating. It's not leaving the market. That is a bullish sign. All right. Another relative rotation graph I wanted to show you here. This is where the benchmark is the XLY. If I like the XLY, why not bring up the component stocks in the XLY? So what I've done is I've gone back and I've added all of the individual stocks, component stocks of the XLY that represent at least 1% of the XLY. Otherwise, we'd have so many charts, so many symbols on here, I wouldn't be able to follow. The two biggest, though, are Tesla and Amazon. And when I look at this chart and I drag it all the way over here to the right-hand side, I want you to look at this table down here. The table, and I'll even zoom in here a little bit for you. Maybe that'll help make it better for you. There are only two stocks in the leading quadrant when you look at performance relative to the XLY, Tesla and Amazon. And oh, by the way, they just happen to represent 38% of the XLY. So I always talk about with ETFs, you got to know what you own. The XLY is doing well because its two largest components are on fire, especially Tesla. But I think Amazon's going to continue moving up after that ascending triangle breakout. We only have three in the improving quadrant. that are trying to make their way up into the leading quadrant. 5. All the rest of them, look, I mean, we got a ton of them down here in the lagging quadrant, right? Another thing I wanted to show you on this chart is if you take a look at what was leading, like here, as we went into June, as discretionary first started to show some relative strength, Starbucks was a stock that was leading it. Now, I think you got to be careful because I think the RRG charts are a great way to try to find trading ideas. I do not believe RRG charts are your go-to as far as determining that you're going to buy the stock. I think this is the first step. I think you still have to pull up the price chart to confirm. You need to see, Starbucks is showing nice relative strength, or it was as of June 6th, but it doesn't tell you what was leading up to, prior to that week in the beginning of June. So here's the chart of Starbucks, and this will give you a little bit different flavor because when we started to show that relative strength, this is what we were doing. This was early June. Now, if we annotate this chart quickly, I can tell you that we had a price breakdown at just under $84 on this gap down. We took out the prior low just below 84. Look at where we went to on the rebound to 84, just below 84. We essentially lost price support and went back and tested it, and now we're rolling back over. So if you used the RRG only and you looked at this chart as of June 6th, you would have said, hey, Starbucks now is one of the best stocks in consumer discretionary. Let me jump on it. Would have been a big mistake. You would have lost a lot of money here over the last 3 or 4 weeks, 4 weeks, because we were hitting resistance at that time. Just because you're in the leading quadrant doesn't mean you have an uptrending chart. Doesn't mean that this is a leader. Because the other thing I would look at and show you before you get too excited is check out relative strength. I can do that. I can pull this chart up right here. And the AD line for is still, I mean, we've been downtrending. We rose a little bit during this push to the upside, but we were still way off the high in terms of our AD line. But look at relative strength. Starbucks relative to restaurants. We took a big hit here. And yes, we saw a little bit of a relative rebound, but this long-term downtrend continues. We never went back to where we were prior to the earnings report on Starbucks. We never went back up above that relative strength. And now we're rolling back over again. And by the way, the group isn't good. So if you're going to look at anything in the restaurant space, for me, it would be Chipotle. There might be a couple of others, but Chipotle on the latest pullback would make a lot more sense than Starbucks. So again, relative rotation graphs tell you a lot. They're great to visualize, but at the same time, they don't always mean that they are great stocks. Now, look at something else like ROST Stores, and ROST Stores moving up, TJX. Both of these, let's pull up those two charts. So we'll go with ROST Stores. This one actually is in a nice little cup and probably into a handle right now. AD line on this one's not great, though, so I can certainly see some counterpoints and some arguments that could be made to stay away from it. But the overall chart pattern, we have an uptrend followed by a cup with a little bit of a handle. If we get a breakout above 150, 151, that would be a great sign. The next one I wanted to show you was TJX. And TJX, look at this here. We had a big breakout back in May. So this strength wasn't a dead cat bounce, but in this case, TJX is actually making a big breakout. So TJX on the relative chart, on that RRG chart, is much different than Starbucks, even though the RRG chart kind of shows similar characteristics. Starbucks is a downtrending stock, a underperformer in the restaurant space, and then you've got TJX, which is actually an outperformer and a stock that's been trending up and has just recently broken out. So just wanted to kind of show you again how the RRG charts are unbelievably effective in helping you find some great trade candidates. But again, you don't make your trades from there. But this is an exclusive to Stockcharts, folks. Another reason why I use this platform. It's such a great effective way to be able to look at relative strength. And relative strength to me is as important as just about anything in the market other than the actual price and volume combination. But relative strength is very important. And I think RRG is one way to kind of show you how it works out. All right. I thought the other thing I would do now that we're talking about rotation, I wanted to go through and show you a couple of or a handful of key industry groups that have led this secular bull market over time. So what I've done is I've pulled up this RRG. I'm going to go back right now just 6 months, but I'll show you the long term as well. Here is the 6-month chart of the semiconductors, software, autos, broadline retail, and internet. So those 5. Now, if you look right now, markets at a high, look at all 5 of these groups over on the right side of the chart. That, before you look at anything else, should tell you these are 5 groups that have relative strength. They may not all be heading in the right direction. Autos right now are soaring. That, we know that if you've been watching Tesla. Semiconductors have been going straight down, and they're into weakening. They're not far from moving into lagging. Now, this is on a 6-month chart and a daily chart. If we go to weekly, and let's just go back 3 years and hit this update, notice semiconductors, and we'll do this max chart here. As we go through here, there goes semiconductors as we move into 2024, right? Tremendous relative strength. Then we have the weakness in April. We pull back, semiconductors consolidate, weaken for just a minute. And then look at the latest run. We see this move back to the upside. And so it's back into the leading. Now, this looks like it's strengthening. But again, this is the weekly chart. So the last week or two, or week and a half, where we've seen semiconductors going down, it's not, it takes a while on a weekly chart for that kind of behavior to generate more weakness in the group on a relative basis. Daily chart, it happens more quickly. If we go to hourly, if you want to, pull up 1 month and go to hourly, and you want to look at semiconductors, let me drag through. So let's just watch semiconductors over the last month on this hourly chart. Strength, weakness, now it's coming back up, strength again. Then we come down, weakness, now, took a pretty big hit there back in June. That's where we had the NVIDIA top and some of the others. Look, all of a sudden, how that jumped back on the hourly. Now it's coming up into improving, hesitating, still hesitating. Now it's going back into weakening. And now it's turning back up and trying to strengthen again. But it's still pretty close to the center line. So it's showing a little bit of relative strength on the hourly chart, but not really anything. We're weakening on the daily chart. So again, the time frames matter when you go through these RRG charts as well. But anyway, I wanted to show the daily, and we'll do the 6-month. Because what we're seeing now, if we just follow the autos, autos earlier this year were horrible, right? Look at that. It can't get much weaker. It's way off to the left. Starts to rise, gets almost deleting, and then right back down again. Then down with the swoon in April. And then here we go, moving up, coming back to the center area. And then autos, all of a sudden, just shooting back to the upside. So again, semiconductors weakening, but the market's not dropping. Why? Well, one reason is Tesla and the autos absolutely flying. Money is rotating. How about software? Software in the leading area as well, moving further and further to the right. Now, the move because of the length of the tails, you can see autos doing much more movement to the upside than software. Software is strong. It's in the leading quadrant. It's leading the S&P 500, but not as much and not as fast, which is fine. But we're still seeing money rotating into it. How about broadline retail? Look at what's going on here. So as we drag this back, the latest push to the upside, all of a sudden, broadline retail, which includes Amazon, pushing to the upside. And then the internet group, again, just over this last move to the upside, starting to strengthen. So yes, semiconductors go down, but look at these other areas that have been leaders throughout this secular bull market now taking their turn. And that, in a nutshell, is why this stock market is not going down, because the money is rotating. It's not leaving the stock market. Anyhow, that's all I got for you today. I do want you to take a look at this final QR code, because if you want to follow EarningsBeats, you want to follow me, if you scan the QR code on your screen, it will take you to a landing page that will show you exactly how you can follow us across all types of different social media. And, again, I think if you incorporate some of our style into what you already know and what you already do, I think you're going to see some improvement in your own personal performance. Anyway, have a great day, everybody. Happy trading.